Hey everyone, welcome back to Corporate Decoder. Today's report comes from New York Life Investments Funds Trust, so get ready to navigate a sea of numbers and acronyms as we try to see what really matters, kind of like trying to find a matching sock in a dark laundry room. But before we dive in, we're going to uncover what is really going on with these funds, from management shakeups to behind the scenes deals, and as usual we will focus on financials. If understanding the hidden language of corporations is your thing, subscribe for more straight-talking insights because Corporate Decoder tells you what Wall Street doesn't want you to know. We also have a Discord community where you can discuss all things corporate and decode these reports with fellow investors. The link is in the description below, so come join us after the video. Right off the bat, this is a shareholder report, not a regular filing like a 10K or 10Q. This means it's mostly marketing fluff aimed at convincing investors that everything is awesome, but we will still analyze it as a corporate decoder we can't resist. Okay, here are some of the overall numbers. We will refer back to it when each funds are reviewed. The fund's net assets totaled almost 50M. They have over 20 portfolio holdings, advisory fees paid sums up to 77K, and almost 90% of portfolio turnover rate. The ETF allocation fund sector has a complex web of investments into funds that follow different indexes. The primary goal of these funds is asset allocation, meaning moving client money safely and diversifying it amongst those other smaller funds to achieve various investment goals. Let's look at something meaningful, changes to the funds. First, the funds has a rebranding. The report says that the fund's name change had no impact on the management of the fund, which is probably true, but it's what the report says. Portfolio managers are definitely meaningful. Apparently they had a shake-up of team with the introduction of Jonathan Swanee, Megan S. Kim, and Amit Soni. Okay, let's start with the NYLI Conservative ETF allocation. This aims for a safe investment profile with low capital turnover. The fund made roughly 4% after charges and 7% without charges. This fund consists more fixed income, 54 King Darth, 50 at Campters in the equity department, 40% all. The fund's success was impacted by underweight exposure to non-US markets called developed international equity, increased duration of when yields rose, and exposure to booming AI sector REITs, particularly in data center related ETFs. On the other hand, high capitalization of companies they own didn't do well for them, meaning they own small sized companies that were outperformed by big ones. Class A shares, including sales charges, made roughly 4% annual total returns for the year of 25. Nothing impressive. What is very interesting is that this is a diversified type of ETF, meaning they are made diversify to balance assets and to lower volatility, but it underperformed compared to all high-performing stocks as well as conservative composite indexes. The past 5 years were a turbulent decade with a lot of opportunity. The diversification didn't really make the cut, it seems. Now let's consider the NYLA CBRE Global Infrastructure Fund. This fund has higher expense ratios than the conservative fund, with the share costing 1.24% of its investment compared to the smaller 0.880%. This fund's objective is to seek total return, which also means it can handle more risks than the previous one. The table outlines that the fund's performance of 1650% was affected by utilities, European stocks, while not taking position in emerging markets caused lack of contribution from emerging markets. The weakness was mainly from the midstream and transportation markets with US stock. The fund's Class A shares made 12.34%, including sales charges, and 19% without sales charges. While these numbers look pretty great, most benchmark stocks did far greater, at least 12%, 17%. It seems this particular sector of infrastructure hasn't played out in the most profitable way, even with the help of booming REIT. We see some holdings topping at 4%, including WEC Energy Group, Atmos Energy, Energy Corp, Norfolk Southern Corp. This is rather diversified, which confirms the fund is focusing on reliability and not capital appreciation. I won't bother reading the names. This list is not too interesting. And let's go to the NYLA CBRE Real Estate Funds now. The objective is again a pretty generic one, just seek returns. The investment table compared to REITs looks pretty bad, underperforming all the relevant industry comparisons by large margins, including MSCI, US, and Morningstar. Even the class with the largest performance underperforms sector averages. So that's the thing. The summary outlines how strong stock selection in cell towers affected the impact, along with limited exposure to life science REIT sector. The detractors list underweight exposure to healthcare and exposure to outperforming lodging sector. As for equity, this report states having over 47.09 holdings in communications. and real estate related top are the usual REIT suspects. Topping 9%, American Tower Corp, Welltower Inc., which if you scroll down, the diversification is shown, which mostly includes top net lease properties, residential, technology towers, and healthcare facilities. Again, this particular fund doesn't look that great, and there are many alternative REITs out there for consideration. NEI moderate ETF allocation, again targeting long-term growth. The fund is again very vanilla and average, as we can see. The report talks about 5% for the class charges. From the performance points of view, all major index benchmarks for total returns is pretty bad sexpin. P 5500 returns, bonds, global index, and everything else is almost triple what this fund returns. That is not a good sign for the fund's holdings. The portfolio consists on the equity side of major ETFs, while fixed income included more aggregate bond listings. Finally, let's see the NYLA growth ETF allocation. The word growth in the title is always promising, as this particular ticker's objective is long-term growth while still having a broad number of companies. After the usual distribution charges and sales charges of nearly 5%, the fund's one-year return is a 7.21% one-year growth, with over 10% annualized over half a decade. The gains were affected underweight to developed international equity and increased duration on yields exposure. But on the other hand, an overweight position in capitalization wasn't ideal. So what's our overall take from decoding a report of this type? In general, with such large funds, the objective of the investment is hardly rocket ship returns, since it's not their job to speculate, but to generate positive annual reports while still maintaining steady dividends. That is the objective. However, you do need to consider if it is actually worth it to pay for a manager if they're not outperforming other base indexes by choosing sector allocations that can provide greater returns, as is its purpose. It is ultimately based on the user if to keep their money with these ETF allocation funds or to invest on their own, which would net better results, but at their own risks. Alright, that's our breakdown of some funds that NY Life provides you with. What's your take, and how would you manage your money differently? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate America. And lastly, don't forget to check out the Discord in the description. Thanks for watching, see you next time.